Morena, kia ora everybody, and welcome to the launch of the Responsible Investment Super Study for 2023. Tēnā tātou katoa, ko Dean Higiti taku ingoa, no whakatū ahau, he pāpā ahau, ko te whānau taku tuatai. I'm Dean Higiti, the Executive Manager at RIA, and I'd like to start by acknowledging the traditional custodians of the land that I'm on this morning, Ngāi Tahu, over here in Aotearoa. Noting we're a geographically spread group today, I'd like to extend that acknowledgement to all the different lands that people are joining us on this morning. So we are very excited to be able to launch RIA's latest piece of research. It covers the 50 largest super funds in Australia, as well as the Future Fund, which for those of you from outside Australia is a large sovereign wealth fund. And this is the fourth report of its kind that we've published dating back to 2016. It's a really key tool in identifying and measuring the key trends we're seeing right across the superannuation sector within Australia. This is a really important piece of research because pension schemes really are a critical piece of the puzzle when it comes to managing assets responsibly. And what we know that they have the ability to set the agenda and drive change through the internal strategies and the processes they create, as well as the mandates that they issue to the wider market. And so while pension schemes are really critical right across the globe, that is really especially true in a market like Australia. As a percentage of GDP, we have the third largest pool of pension funds anywhere in the world. And at a total at the moment of $3.4 trillion, it's a significant pool of capital. And it can be put to work to help us create a brighter and more prosperous future for all Australians, while also delivering really strong financial returns for us as individuals. At the same time as all of that is happening, it really is an industry that receives a lot of scrutiny and regulation. It's been a really busy time in that sector. Your future, your super, and disclosure regulations, especially, are really shaping the landscape. And a lot of the research will shed some light on the impact of those as we move through the findings. So the plan of attack for us today, I'll hand over very shortly to my colleague and RIA Research Manager, Dr. Zsuzsa Banhalmi-Zakar, who's got a wealth of experience in sustainable finance in both the public and private sector. We'll then move to a panel discussion. We'll look to unpack some of the results so that we can really dive into what they mean and also how the findings can be a really critical reference point for where we are today, but also a pathway to where we're going to be going and where we need to be going in the future. Before we do that, some quick background on RIA. For those of you who don't know us as well, RIA champions responsible investing in a sustainable financial system in Australia and New Zealand. And we're dedicated to ensuring that capital is aligned with achieving a healthy society, environment, and economy. We've got over 500 members who manage approximately $40 trillion in assets globally. That includes most of the major super funds, fund managers, banks, brokers, impact investors, and financial advisors. As always, we've also got some thank yous to do before we kick off. This is a really huge piece of work that relies on a wide range of contributors. As with all of RIA's research, we need the data provided from members to pull all of this information together. We know that you're busy. We know how hard it can be to prioritise that time, but it allows us to create reports like this, which support the industry, and we thank you for carving out that time. RIA's research is also exclusively funded by our members, whose financial contributions allow us to deliver insights like these, which do benefit the entire market. And we're especially fortunate to have long-time RIA member PIMCO Asset Management, providing extra support as the industry partner for this report. So it's the second time PIMCO have partnered with us for the Super Study. They're also long-time supporters of our benchmark reports. And I'd really like to welcome Victoria O'Keefe, Vice President of PIMCO, to say a few words to get us started today.
Thanks, Dean. Good morning. We wanted to extend a warm welcome to everyone from PIMCO. We're really proud of our partnership with RIA, and we're delighted we have the opportunity to support the RIA study for the second time in a row. The Super Study for us is a landmark research report, and we always look forward to sharing it with our colleagues globally. As Dean mentioned, asset owners are really in the driver's seat when it comes to implementing change, and today provides an opportunity to shine a light on their ESG leadership. PIMCO looks forward to continuing its collaboration with the Australian super industry on ESG solutions. I'll pass it back to you, Dean.
Wonderful. Thank you so much, Victoria, and thanks again to PIMCO for your ongoing support. I will now hand over to my colleague Julia to highlight and run us through the key findings.
Great, thanks, Dean. A warm welcome to everyone, wherever you are. I'm delighted to be able to share the findings of the super study with you. To first set us off, I'm just going to talk a little bit about the study and what we're attempting to do and what we've managed to do over the last year of working on the super study. So the study's target has traditionally been the largest APRA-regulated super funds, Australian only. And in addition to that, we often try to include smaller super funds that represent sort of niche asset owners, faith-based. We also want to represent public sector super funds as well. So it's a little bit of a mix. Our target is the top 50, and on top of that, we include others. We ended up with a total of 53 super funds, including Australia's Future Fund that we have assessed, which is exactly the same number that we did back in 2021. The study we conduct, because it is so comprehensive, and I'll talk about some of the reasons why, we only do this every other year. And this is purely focused on asset owner ESG or responsible investment practices. Okay, it's sort of as a match or a counterbalance, I guess, or a different perspective, but it is based on the benchmarking study that we do we do every year, and that's for responsible investment managers. Okay, so this is the asset owner equivalent, I suppose. The time frame is a little bit difficult to pin down. So when you look at the report, which is always available on our website, free to download and free to view for anyone, any member of the public. You don't need to be a RIA member to have an access to the research report. So you'll see that each of the graphs and figures that I represent will also have the source or date indicated when it is not within the typical time range of the June 2022 and June or July 2021 timeframe. This is because our survey is conducted at the start of this year, and it does relate, the data does relate to the past year, but in some instances it becomes really difficult to discern what has happened in 2022 and what is current practice. The study relies heavily on the framework of good responsible investment governance. This is a series of questions, an assessment that is based on asset owner practices only. It was co-developed with members and asset owners some years ago, and each year we review and refine those questions and the validity of the different parts of the framework. I'll show another slide that shows you what's actually included in the framework for your information. On the right-hand side, you'll see this graph that's total assets of super funds covered in the study by different categories. So RIA kind of has their own category. It's not 100% aligned with APRA's categories of industry super funds, retail, public, and corporate. But what this graph shows is that industry super funds carry the largest proportion of the assets. So that's 49% of total assets, APRA controlled assets, and then followed by retail sector, public and corporate sector is the smallest. And this tendency has been going on for a number of years. Next slide, thanks. So one of the key features, and I'll point out a few key features of super funds that I think really shape the sector and how we approach our assessment of responsible investment leadership. The first one is the role of the external and internal investment managers. So one of the fundamental questions we need to nail down when we look at super funds is what proportion of investment is managed internally. And so we keep an eye on this. There is really no, I didn't want to put up any trends on this, But what we've actually found is a growing tendency towards two extremes, either a 0 to 10% internally managed assets or over 50% internally managed assets. And then we have a small group that manages about 11 to 20% internally. This has, the proportion of internal management carries significant implications to how super funds are able to, I suppose, how they're able to push their own responsible investment or ESG agendas through down to the asset level. So there are two completely different strategies when you're managing something like that internally and externally. So the main ESG consideration that super funds include in investment management agreements, so this is in case they do have an external investment management, are listed in the bullet points on the left-hand side. Act in accordance with fund engagement and voting policy, incorporate specific ESG factors into investment decision-making, act in accordance with the fund's responsible investment policy, and so forth. And then also the performance of ESG analysis, monitoring, very important, and reporting. So these are the typical aspects or issues that are included, or processes that are included in these investment management agreements. Now, just a small note that all of the leaders do all of the above, okay, to some extent. So that's what we're really striving for, to get across your ESG, your super fund's ESG principles and policies. You need to make sure that all of these things are included in your agreements with your managers. Next slide. The second sort of huge impact on super funds over the last year or so has been the impact of the new portfolio holdings disclosure legislation, which is an amendment to the Corporations Act. Now, this was introduced in 2021, but it really only came into effect in 2022. So this is when we see the full, impact of legislation. And lo and behold, legislation does work. In other words, the green bar shows that portfolio holdings disclosure, 100% of super funds, of the 52 that we have, super funds have portfolio holdings disclosure that is in line with the regulations. Now, this is not a complete full portfolio holdings disclosure, so it's not entirely comparable to the blue bars, which are last reports data from 2021, but it is a significant step forward, because if you look at the blue chart or the blue bars, you'll see that 62% of super funds in 2021 only disclosed up to the top 20 holdings. And then now we actually have 100% disclosing a significant proportion and details, a lot of details about their investment and assets. So that was a huge shift for the industry over the last reporting period. On the next slide, one of the things that APRA does fairly well, I think, is the gender diversity on trustees and that sort of breakdown. So they have longstanding data on that. So if it's conveniently available, so why not, tackle it and have our own assessment on it. It's also really important, an objective for RIA, as well as, I think, personally for me as a woman, to see the gender diversity agenda being pushed. Now, a disclaimer here is that the data is only distinguishing between men and women. So it's only binary. APRA only collects binary data. Okay, so just bear that in mind. It's not RIA's perspective on this issue, but what data is available. So what you see is the two charts. The colors mean the same thing for the two charts. So yellow indicates the proportion of balanced boards, which is, we're following the 40-40-20 principle. So 40% men, 40% women, and 20% of either. So that changed slightly, and I think we're going to stick with this breakdown, as this is where the industry is going. This is where common sort of industry practices are going. What you see here is that balanced boards are now 57% of the composition of all trustee boards. A huge win, I think. Of course, there is still boards, but 38% of boards have less than 40% women, and only 6% have less than 40% men. The gender composition of boards by fund category is also interesting. We see that industry and retail funds are really taking the lead, whereas the public funds and corporate funds really need to step up to ensure their gender diversity on trustees and boards is seen and carried through. On the next slide, you'll see the top drivers for considering ESG in investment decision-making. This is a question that we ask every year, and it is also mirrored in the benchmark report, which looks at investment managers. So this is our asset owners. And while the top three or so are the same, what we see is the demand from retail investors has really increased over the last reporting period. So it was 14% in 2021, and now it's 38%. So we do see some changes in terms of drivers for ESG amongst super funds. The next slide is growth in assets of responsible super fund leaders. So here we have a trend graph from 2019 to 2022, which is this reporting period. And what we see is that leaders are increasing. So even though we have 10 leaders this year and we had 13 leaders in 2021, the assets owned by those leaders are higher. This is partly due to mergers, changes in the industry, and so forth. So overall, leaders now own $40 billion more assets than the previous reporting period, while the number of APRA-regulated entities actually declined by approximately 30%. So I pulled out some figures on Friday. So APRA-regulated superannuation entities were 97 in 2021 and now 69. At the fund level, which is sort of a different breakdown, we had 164 funds in 2021, and now we have 109. So it's a 29 and a 34% decrease in overall APRA-regulated entities, which is also had a huge impact on the industry and also created a bit of headache for us doing the research with all the mergers going on. So I already introduced the concept of leaders. Now I want to show you this framework of good, responsible investment governance. So we have 5 pillars. So it's similar to the benchmark report for those of you, again, where we have 4 pillars. Here we have 5 pillars. We have a heap more questions than we do for investment managers. The first pillar, so the pillars are meant to follow through from commitment, governance, from inception through to implementation to monitoring, as well as reporting towards the end, where we want to see the evidence and publicly available information. What you'll see here is that implementation is split up into 3 different subsections. So we do focus heavily on the different types of implementation that different super funds, based on their business models, exercise, I suppose, or practice. So we're trying to capture them all. This results in a maximum score that is different for each individual super fund based on whether they use external managers or the internally managed funds. You know, we see a whole spectrum of those. So we try to adjust for that so that we take into account that the business model really can govern, you know, what sort of practices we can see in the implementation. So again, this framework has been developed with super funds some years ago, and we still believe that those pillars and what they cover are valid issues for today. On the next slide, you'll see how leaders, the average score of leaders in 2023 and 2021. So there's some interesting trends. There are some things the leaders are doing better than before, and there are some things that we didn't think they were doing as well as in 2 years ago. Governance and accountability, mostly this relates to the availability of information. Do we have insight as to how governance and accountability works in your super fund? Who is responsible at what level and what for? This is kind of what we're looking for in that. The commitment levels are high, which is really, really great to see. The ESG integration implementation is also higher this time around. Manager selection and monitoring. So there's much more systematic action and activity going on. That's what we've witnessed. Values investing and impact investing was down, so we didn't see as much evidence of what is actually going on and any framing of values. And that could be an interesting topic as well for the panel. So this is just a comparison then of average score of leaders between 2023 and 2021. Next up is the performance data for responsible investment super funds. So on the right-hand side is the table that's included in the report. We use the ATO's your performance, your future, your super comparison tool, but it is for my super products only. So at the moment, this is sort of the best we can do. And what we see here is that we compared the leaders, so the 10 leaders, my super average performance versus the non-leaders. We find that leaders performed better than, basically on par, slightly better than non-leading super funds. And also leaders recorded a 2% growth in client accounts, which could be that they're offering something to the Australian public that people are looking for, but it could also be an impact of mergers and changes. The next slide talks about this is a completely new data set, and Mark, who's on the panel, can talk to this a little bit more. So Sustainable Platform provided us with data on weighted average carbon intensity of various super fund products. So we then compared RIA certified super fund products to non-certified products, and we also compared the products of leaders versus non-leaders. So this is weighted average carbon intensity, or WACI, some of you might know, which is a portfolio measure for investors. And what it's showing really here is that, and we have a couple of data, I'll talk to graph in a bit more detail, but what it shows us is actually the underlying assets and the carbon intensity of various portfolios within super fund products. So we have the two colors. The green one signifies scope 1 and 2 only measurements, and the blue graph shows scope 1, 2, and 3. Okay, so what it shows us on the left-hand side, the two bars, that RIA certified products have a much lower carbon intensity than non-RIA certified products. And on the right-hand side, that the leaders super fund products also have a much smaller carbon intensity than the non-leaders. And then if you compare the green bars versus the blue bars, you'll see the difference, the huge difference that scope 3 makes. So green again is scope 1 and 2, blue is scope 1, 2, and 3. So you see, once you include scope 3 in your calculations, that this is an immense difference in outcomes and what is where the carbon intensity lies. Okay, so the next slide is the change in target setting practices among super funds. Here we're specifically, these are questions specifically related to targets, not just commitments. So we're looking for, you know, the specific time bound, sort of the smarter principles of targets. Heavy focus on climate change related targets, which is great to see. And these targets are by and large Paris Agreement aligned goals and also sectoral decarbonization. The other category was quite heavy this time around. So we do see other targets popping up, specific emission reduction in portfolios, own internal targets, proxy voting, and sort of a range of other targets as well. So it's always really good to see targets being reported because they drive action within the funds. The next slide is about the implementation of voting. This is an interesting graph. We also have its counterpart in the benchmark study, the top issues super funds engage on or advocate for over the past year. So climate change, rights of First Nations, protection, labor rights, what you see is actually a mix of all the different issues that super funds engage on. So even though we see outwardly a heavy focus on climate change, but actually in the background, there's a lot of engagement going on about a lot of different issues, which just leads into the data that we have, that we have more ESG teams across super funds, more people, so more super funds are hiring more ESG practitioners. Okay, now the public disclosure after voting is the norm. So that's what we see most often. And we had only one fund reporting voting disclosure intentions, so prior to voting. So at the moment, that's what you can find out, is how your super fund voted on different areas. And the last slide then is at the announcing of the super fund leaders. And we congratulate our leaders. There you see them. It's not easy to be, in the top 25 or so % of the scores, especially for such a comprehensive scorecard. So it's a huge achievement to all of the super funds in there. I just put in a little arrow to show you that we have a new insignia. So if you are a RIA member and a leader, you can display a new insignia, which was introduced this year for the first time. And a very warm congratulations to all of those involved in attaining the leadership status. Thank you.
Wonderful. Thank you so much, Zsuzsa, and congratulations again to those of you who have been identified as leaders. As Zsuzsa mentioned, it's a huge amount of work, so congratulations. So everybody now has a link to that report in your inbox. Absolutely encourage, make sure you download it so that you can get a really thorough understanding of all the dynamics that are at play here. Just a reminder before we kick into the panel, we will be taking questions via the Q&A function. There's already a couple of started to come through there, which is terrific. We should have plenty of time to cover those. We'll certainly do our best, put them in, and Zsuzsa will also be answering some of them as we go through with the panel. So I'd now like to take the chance to introduce the wider panel so that we can dive into some of these findings. And we are very fortunate to be joined by representatives from two of our leading super funds. So firstly, Leilani Weir, who's the Head of Responsible Investment and Sustainability at Rest Super, and also Sandra Cilia, the Director of ESG and Stewardship at Australian Super. And finally, Mark Andrich, who's the founder and CEO of Sustainable Platform, which is a database we use to draw some of those report insights from. And they're also one of a number of research providers that we use as a part of our ongoing certification program. Welcome to you all. So Leilani, I might start with you, but we'll go around from everybody. There's lots of really interesting results to unpack there. What, if I can ask, really stuck out as being the most critical finding, or perhaps surprised you the most potentially when you were looking through the findings initially?
Thanks very much, Dean, and thanks, Ria, for producing this report. There is so much rich information in there that I think it's going to take us a while to keep digesting, so huge thanks. I'm here on behalf of REST. We represent 2 million Australians with their retirement outcomes, and having a report like this to refer to is excellent. So a lot of our 2 million, 50% of our 2 million members are under 35. Of those 2 million, many are in part-time or casual employment, and they are interested in their super, and we are interested in helping them understand their super. And one thing I noticed about this report is if you pick it up, it just tells you about the super industry, full stop. Like, responsible investing aside, it just helps with the super industry. The number of funds, the landscape, the regulatory environment. And also what I loved was the diversity figures. Having those, I'm proud to be part of a 40-40-20 fund with our board as well. And it's incredible to see that and to know that when we're advocating to companies, these are we're living by what we're advocating and engaging on. And the last thing I just say is the governance pillar I find very interesting, in fact that it went from 83% score to a 67% score. Is that because there's been mergers in the industry? Let's unpack that. The fact that a lot of us are now reporting and disclosing to TCFD. where we have to disclose our governance. I think that's just a really interesting finding.
Wonderful. Thank you, Leilani. And we might jump specifically back into that reduction in reporting a little later on. Sandra, wondering if you had any insights you wanted to share?
Likewise. I mean, this report, when it comes out every 2 years, is really fulsome, and it really, to Leilani's point, unpacks the ins and outs of super. So we always look for it with great eagerness. So I'm glad it's here and landed. Certainly from our perspective, one of the areas of surprise positively is that really funds are moving the dial on those core material issues like climate change, getting those areas bedded down within their processes. But I think an area of opportunity, kind of building off Leilani's point, is that not only is governance an area of opportunity for the industry going forward, but also at the end of the spectrum, the measurement piece as well. So we're seeing a lot more of that implementation solidifying in terms of our individual fund practices. It's about really what are the outcomes of that work and how do we measure that effectively. Some issues lend themselves more robustly to that, and we'll dive into that when it comes to climate change as part of this conversation as well. But there are other areas that we are enhancing our practices on, and we really want to start getting processes to measure that effectively and put that forward for our members so they can see clearly the progress that's being made with our investment practices on their behalf.
Wonderful. Thank you so much, Sandra. What about you, Mark?
Yeah, there was two things that really stuck out for me as part of the study. First, to figure 11 on page 17, which is about the top drivers, the top 3 drivers for responsible investment among survey respondent super funds. And the first thing is that risk mitigation or long-term performance is really what's driving ESG and investment decision making, and that's still the #1 reason, which makes a lot of sense. And then the other thing was the variation in carbon intensity between the certified and non-certified leaders versus non-leaders, plus the difference when you include scope 3 or not. And I just did a bit of calculating, kind of extrapolating it over the last few days, and it turns out that if you look at the difference between them, it's about 200 tons of carbon emissions per $1 million invested, if you include that scope 3. And if you look at the scale of the super fund industry now, we're talking about a difference of 200 million tons of CO2 invested in between the non-leaders and leaders, or certified, non-certified, depending on how you want to look at it, on average. And just to put this into perspective, Australia's emissions were 487 million tonnes last year. So that's about half of Australian carbon emissions, just in terms of how you want to look at it. So the change can be quite large, and across the whole industry. I think it's real credit to RIA showing this and driving that change that the certified and responsible leaders are looking towards. And if you don't include scope 3, the difference is about 40 tonnes of carbon emissions per $1 million invested. So it's still a pretty significant portion, 10 to 20% of Australia's carbon emissions.
Yeah, and I think it'd be useful for us to deep dive into those carbon emissions a little bit later on. Certainly the drivers and the demand piece that we're seeing coming through in the super study is really consistent with what we see right across the industry. Those 3 key drivers, one being expectations on performance, policy and regulation that are now coming down the pipeline, as well as investor demand, are now really the 3 that are starting to appear whenever we're either researching or talking to individuals right across the industry. So I think it's one of those consistent ones that's really here to stay. Might start on the policy front with that in mind. We've really seen policy reshape the super landscape in Australia, and I guess one of the really glaring outcomes that we saw in this was the mandatory holdings disclosures 2 years ago. 23% of funds were disclosing all of their holdings. Now that's 100% based on the new legislation. While that's a fantastic outcome, I guess from your guys' perspective, I'd love to get an insight into Why does that actually matter? Like, why is it actually important that we're being transparent with our disclosure homes?
I may start from a fund perspective. So Australian Super has been the journey of full portfolio holdings disclosure way before the regulation came in. So we were proudly part of that 23% that was there beforehand. And from our perspective, representing 3.3 million Australian members, they have every right to understand what we're doing as far as our investment practices and what tangibly they're invested in. One, because it's that disclosure and transparency is important in terms of the dialogue they have with their financial future. But secondly, it's about them taking pride in what the investment activity actually is as well. The infrastructure assets that we're invested in on their behalfs, the property assets, the Australian companies that are doing amazing, innovative work. That's a point of pride in terms of their financial future as well. So I think it's both a risk management exercise in terms of them understanding, oh, what's happening, but also an opportunity set. Look, this is what's going on. And so along the journey, we've always tried to evolve our portfolio holdings disclosure to be more and more innovative, more and more transparent in terms of where things are. We, updated our technology portal as well to make sure that it's easy to use for members so they can easily gather what's going on. And, that just creates this positive dialogue with your membership in terms of what's happening. And I think it ups the standards for everybody more broadly, because it's really clear to our members what we're doing day to day on their behalf. And that will continue to evolve, I think, for every fund who is on this journey as well.
Leilani, what's your view?
Yeah, I would echo that, but also I'd probably extend it to this whole point around funds being very transparent and accountable for what we're doing. For a lot of REST members, their retirement super and savings, that'll be one of the largest investments they ever have in their working career. So having a look through into what they're invested in is absolutely critical. I think one of the other interesting things about that too is, and by the way, Sandra, I do love the technology that you've brought in to easily look up funds, but I do think making it easy for members is very important. And that easy is actually even a step before portfolio holdings disclosure to make sure that members know what option they're invested in. Like the majority of members will be in a My Super option, so they'll know to look up the portfolio holdings for that option. But some members will be in choice options, and maybe they'd forgotten that they'd made that choice 10 years ago. Or so also I think there's probably some scope here also to use portfolio holdings to then engage with members to help them understand the options that they're in and the choices that they have.
Yeah, I think also that just globally, if you look at kind of the standards internationally, any fund with more than 100 million in the US needs to disclose all of its holdings every quarter, from the SEC. And then the Norwegian Sovereign Wealth Fund, which is, I guess, also a leader in managing a lot of people's money, they've been disclosing all of their holdings for at least 10 years, probably more. So I think we should see it more as a kind of a norm and global standard, which we should aspire to, rather than something that to sort of gloss over. And it also helps to, I think, hold funds accountable to match what they say they're doing with what they're doing, and that's obviously really important for transparency and people's trust as well.
Yeah, great. Thank you, Mark. So I think we've also, quite interestingly, though, seen that there's also been some areas where actually reporting is reduced or consolidated. And Zsuzsa, I don't know if maybe you just want to speak to that a little bit, just around what was the change we saw, and then I guess open it up to the group to get a sense of why we think that might have happened.
Sorry, this is about active engagement, or?
Yeah, so this is when we saw there was actually a reduction in some of the reporting that people, or previously we'd seen, I think it was 83% had reduced down to 60 something.
Yeah, so I mean, it's like I alluded in the presentation, that this is a challenging super study for us. It always is challenging. There's always a lot of movement and changes and around, but this time we found it quite difficult to be able to draw lines around where the super funds, what sort of mergers, what's kind of happening, how do we deal with funds that aren't really disclosing, or it seems like information's missing from their websites. We're not entirely clear what is included under a policy or an accountability framework, or how they're going to go about it. So that's an interesting one. The other is, of course, we're going to keep watching this space. I can't say it's the mergers that are responsible for this change or that change, but it will be something that we consider and continue to monitor. And if the mergers are having an effect on overall ESG ambitions or commitments, sort of diluting, or perhaps lowest common denominator is where they decide to meet, that's something that I think we need to be really, really mindful of, that some of these changes it didn't start out that way, right? It started out as something obviously for the Australian public, to some accountability on the side from the super funds, regulators stepping up, and then the trickle down effects, of some of these decisions and changes can be quite far reaching. So but I suspect there's a bit of, it was unclear for us and a number of funds what is actually going on, where they're headed, and the scope of their ESG or RI policies.
Yeah, wonderful. Thanks for diving into that a little more deeply. Maybe particularly Sandra and Leilani, I'd be keen to get your thoughts on, is there a part of this that is maybe starting to feel like a little bit of green hushing might be coming into the organisation? Obviously, there's always going to be that tension between wanting to make bold claims and be really aspirational with where we're going, but at the same time, there are, significant consequences of getting it wrong, and those consequences are growing. How does that play out for you guys within your organisations?
Before I answer,
go ahead, Leilani, you start, and I'll jump in after.
Before I answer the green hushing, I just wanted to go back to Mark's point around the US and portfolio holdings disclosures, because I think what's quite interesting is Morningstar did a study earlier this year in May, and it talked about 26 or 27 other markets where portfolio holdings disclosure happens. And I was really surprised to see that markets like India and Mexico, I think Mexico has weekly disclosures and India monthly. So that was very interesting. And it also got me thinking about our expectations of our investment managers and disclosure in the investment management industry beyond super funds and asset owners, and how that could potentially help with transparency. So I guess that's more on the not green hushing to your question. Green is like making sure that all the information's available. On the entire topic of greenwashing and green hushing, the most simplest thing here is just say what you do, and don't misrepresent what you are doing, and be clear to members. And I think all of this just fits under the financial landscape that APRA-regulated funds are operating in, around making sure that we don't misrepresent or mislead what we're sharing with our members and other interested stakeholders. So I think disclosure means that you just are saying what you're doing, and if you do that, I think you'll be okay.
That's exactly right. I think, you shouldn't be afraid as a fund to really put forward the activities that are genuinely happening inside the portfolio. And I don't think, Dean, to the crux of your question, I don't think that makes us less innovative or less bold in our transparency. It makes us more precise. And that is an important one, from, again, extending the line of full transparency to our members. But that precision is just part of the process, and it allows us to really describe in detail what's happening inside the portfolio. I think there is so much happening when it comes to transparency globally, climate change probably the first bastion, right? With ISSB, with the disclosures that are coming down the pipeline there, the numbers that we need to be producing, the data, to Leilani's point, that we need to be collecting down the pipeline, that naturally we're going to be putting more out there. But that doesn't mean that we have to inflate what's out there. And we proudly put forward the activities that we're doing, because if you're genuinely taking responsible investment seriously and your investment teams are doing the same, there's so much positive work that you can put out there with precision that really paints the picture and crystallizes for the members that we're investing on behalf of what's actually happening with their money. So I guess for us, if you're doing what you're saying and saying what you're doing, it gets you to that finish line. And ultimately, everyone wins because there's precision in the disclosure. We're putting good information out there for members that they can use, and they have a real, genuine sense of what's happening or what's not happening with their money.
And Mark, maybe it'd be interested to get your view as somebody from a different perspective within the industry. You're obviously dealing with a huge amount of data from right across the board. How do you find the disclosure landscape? Do you think the current disclosures in Australia go far enough, and are super funds doing a good job of being transparent with their information?
Yeah, I think there's, I think on the whole, yes, there's probably something that could help, which is a format for disclosure that's consistent between and among the funds. I don't know who's, I don't think there is any group that's responsible for saying this is how it should be done, you know, whether it's ASIC or APRA. But I think, you know, again, in the US, they have consistent reporting on that. In Australia, if all the super funds were able to provide, you know, the ISIN and the etc. for the holdings and the way they disclosed it, it would be much easier for funds to compare themselves against others, and also for different groups, including us, to actually see what the holdings are. And then, yeah, I guess in terms of the green hushing and the green washing, again, I think that I think what Leilani and Sandra said actually is just, yeah, it's absolutely perfect and just covers all of that.
Yeah, great. And certainly, you're not alone in, I think, hoping for a future that involves some slightly more templated and streamlined reporting standards and frameworks. But at the same time, also, I do know there's a huge amount of work going on in that area right across the board, and a lot of what the Australian government is engaged in at the moment in terms of scoping out with a sustainable finance strategy, but also looking at climate-related disclosures and things like that are certainly moving us in the right direction, but it's a big job. I think it would be fair to say, with a long way to go. Want to narrow in on climate specifically, because I think one of the things that we see in the report is that clearly the top of mind issue for the sector is climate, right? And I guess question one would be, you know, does that really reflect what you guys are seeing, you know, working in the industry? And then as a second point, and a really critical one, I guess, is that drowning out other really key issues? And is there, and what is that opportunity cost by being so focused on climate? I'm happy to just throw that open to anybody on the panel.
Well, I think I'll start. Certainly, climate is the most progressed of the ESG issues that we see, both from our understanding of the issue inside the investment process, but also increasingly the environment we're operating in terms of policy, numbers, measurements. So it's moved a long way compared to other issues. And so naturally, it gives it a more solid base by which you can integrate it into your investment processes. It's mission critical for any responsible investment or ESG team to really get a good handle on their climate change approach and that trajectory towards Paris alignment and net zero by 2050. So it's fundamental to the investment process. And it does take a lot of time, energy, and resource, both from centralized ESG functions, but also the investment teams, to be able to manage the risks and opportunities that climate change presents appropriately. That being said, you cannot ignore the other areas. And we saw in the infographic that Zuza talked through, the issues like modern slavery, First Nations considerations, labor rights, all of these material issues have bubbled up in recent history in companies and assets that we hold, and they will continue to be material issues. So we as investors would not be doing our jobs appropriately if we didn't consider all those areas as part of the investment process along the journey, where they are material and where they manifest. It does take time and energy and resource, and it takes almost a really critical mind to say, okay, let's pivot and make sure we get everything. But if you're focusing on performance and materiality, naturally those issues are going to come into your line of sight. And naturally, you're going to have to evolve your approach to them over time. So for instance, at Australian Super, we have a workforce specialist that sits within our ESG team to help us really fine-tune our approach to labor rights, to modern slavery risks, to supply chain as well. So we can get that consistent approach in that area while the policy regime and everything around us is still evolving and still moving the dial there. So I think it's hard sometimes to pull away from climate change because it seems so far reaching, but you're not doing right by your membership or the investment process if you're not looking more broadly. And we have to, and we do.
Yeah, it's climate's almost a multi-layered systemic risk that investors are working through. And I say it's multi-layered because when we look as a super fund, I mean, REST has over 80 investment strategies that we will be overseeing, many other, direct assets. And in doing that, ESG integration happens across all of those strategies. We know exactly where those strategies are integrating ESG, and climate is always a question and an assessment in that process, as is modern slavery and other ESG risks and opportunities. So number one, the ESG integration is there. I think where it gets interesting is as you roll that up to the whole of fund level and you need data at that aggregated level, it's easier to report qualitative data, like we know where there's labor risks. We know where there's governance risks. We know where there's even misalignment between the UN Global Compact, for example. But getting that at the whole of fund level, climate data has made that, in simple terms, just a little bit more manageable because you've got data that you can analyze and look at, whereas some of the other quantitative data with some of the other ESG risks are not necessarily there. So it's more of a qualitative investment strategy aligned process. In saying that though, of course, most of us have been involved in responses to climate disclosures from Treasury this last year. We've had 2 opportunities to comment. We've also, many of us have just responded to the Sustainable Finance Strategy consultation. And with all of that, there's been a real feel in the industry that it's climate first. And that's accepted, knowing that, nature, labor, human rights is coming. So I think it's like a crescendo. We're building up and we're getting better and better at this.
I think the climate alignment piece also then moves naturally into biodiversity and reforestation, and because if a fund is doing well on its climate alignment, it's probably got a lot of these other investments that are reducing pollution, for example. With fossil fuels, there's a lot of pollution causing health issues, not just the change in global temperatures. And then I think also, the greenwashing risk work does mean that now, also if you're claiming or saying you've got this investment, and it's great just because of the climate focus, if there's then water issues or other environmental issues that hit the news or companies get fined for, then that does look like greenwashing from anybody's perspective. So all those other, metrics can be looked at around the non-carbon as well, in general for sustainability.
And Mark's point around the intersectionality of issues is really important because we do see that you can't isolate climate. So biodiversity is a good example, circularity is another, but when we talk about just transition elements as well, you sometimes cannot disentangle these issues. And so naturally, a holistic approach to investment will mean that these issues will interplay, and a climate approach will have an impact on a labor approach or a circularity approach or vice versa. So it is really important that whilst climate is most progressed and maybe dominates the airspace a bit, you can't take it as a silo and actually look at the whole picture for every investment decision. It's hard, to Leilani's point, in terms of the numbers necessarily sometimes, but I think in practice, it's easier and it's getting more and more efficient to be able to do that with some rigor as far as the portfolio goes.
Maybe just in kicking over to a couple of the questions that have started to come through, and just a reminder, we are taking Q&A, so thanks to those who have put them in. You know, Australia obviously has an incredibly unique mix. If you look at, say, the ASX 20 in particular, that is an incredibly carbon-heavy index to be operating off of. Within that landscape, and with super making up such a significant portion of the assets being managed in Australia, can somebody or would somebody like to speak to what does the engagement in that area look like when you're dealing with large carbon emitters, you know, who might be at various stages of a transition plan? What kind of engagements have you seen, and have you seen any kind of activity going on there?
So I think it's really important as a first step to understand where your emissions are coming from in practice in the portfolio. So we do a lot of work in terms of understanding where our emissions are actually coming from with some precision, and what the emissions will come from in the future when it comes to net zero by 2050 as well. So we're looking at the commitments of our portfolio companies today and what that means for the future trajectory of the portfolio. And we understand who are the top emitters in the portfolio as a whole. So we publish, as part of our climate change report, our top 20 emitting companies and assets. And so when you understand where the bulk of your emissions are coming from, your engagement, or at least from an Australian super perspective, your engagement becomes much more targeted. So we're able to actually unpack the transition plans for these assets and companies to understand what the trajectory looks like, what are the knowns and unknowns for them when it comes to their pathway, and what needs to happen in the market more broadly for them to achieve that net zero by 2050 commitment that they've made. This means that our engagement becomes much more targeted. We're talking about specific plans in the specific context. So a very bottom-up approach to climate change management. It also means that we have a lot more information with more rigor to bring into the engagement to sort of tease out these plans and what's happening in practice. And we're aided by a lot of fantastic work in the industry. So Climate Action 100 Plus is net zero benchmarking, the work that's done through collaboratives like RIA, where we see those pathways and what good looks like and what great looks like. We can use all of that as part of the engagement process, and then really go in targeted in what a transition plan looks like for a company in a highly exposed or a medium exposed sector, and go from there. It takes a lot of elbow grease. That's why, you know, ESG resourcing is very, very important when it comes to that. But certainly it yields more productive, more precise engagement with portfolio assets and companies. That's been the Australian super experience.
Yeah, I think what's interesting is the weighted average carbon intensity of the ACWI, the All Country World Index, is quite less, may I say, than the ASX 300. And most Australian super funds have a home market bias. So I think that's a really interesting just investment landscape dynamic to start with. And then off the back of that, like Sandra mentioned, for Australian Super, REST also has our top carbon intensive companies identified in our sustainability, responsible investment and climate change supplement. And I mean, we've even identified down to it, those 15 companies are responsible for 74% of of that sort of Australian exposure. So it's quite interesting that it does help you target those companies, and it does mean that active ownership has never really been more important for those companies, and it helps you where you spend your effort and your time and your engagement, and when you're putting pen to paper and writing letters and spending time with management teams and boards, whether it's through a service provider collaboratively or direct, is hugely important.
Just sticking on that topic for a moment, we saw, in the last couple of weeks, there's been some pretty high profile in the media, some investments in the British energy transition from a couple of sort of key investors, one being super funds. Are there things that we need to do in Australia to improve the opportunity for renewable energy projects and renewable energy transitions? And I'd probably also link in there, and there's a couple of questions in here on this around, is there greater opportunity for a privately funded, publicly funded, blended finance model to start to kind of drive that? Is that a potential opportunity we could look at? That's about 3 questions all in one, if anyone wants to have a crack at going with it.
I could start on the policy dimension. I think what we're seeing, definitely we've seen leadership from the UK and our European counterparts in terms of the environment that they've operated in around climate change and leaning into the energy transition from that perspective. And I think in Australia, we're quickly moving up the curve on that. All of the consultations that Leilani mentioned earlier, and what RIA has definitely been actively a part of as well, they're leading to a more precise and defined environment by which we can invest into when it comes to the energy transition. It's very important that you do take into consideration what that transition looks like in that pathway, and also those main movers in the economy who are helping catalyze that transition as well. So as a large super fund with over 300 billion in assets under management, we, for all intents and purposes, own a slice of the economy on behalf of our members. So it's important that the environment that we're shaping, the companies that we're invested in, are on the same path and they're speaking the same language. And I think we're getting there from that perspective, which naturally leads to the second question of, well, what does the performance look like long term for these opportunities? And I think they're getting better and better with that certainty as it comes in the Australian dynamic. So I think investors are going to lean into that more as the policy certainty crystallizes around us as well. Leilani?
Yeah, you can probably see my background. This is Colgar Wind Farm. Rest are 100% owners. It's a wind farm in Western Australia, and we've been owners of this asset for over 10 years, full owners for over 5. So, and we've recently announced some more investments associated with that asset. So we are always looking for opportunities. We have been invested in renewables, and both locally, domestically, and internationally for a long time. We also track this. So we've got about 1 billion in physical renewable assets in our fund. We've got about 2.4 billion that attributed to what MSCI would tag as a low carbon company. And we've also got about 317 million in green bonds. So this is all helping the uptick in investment in renewable across the country. The other really important thing here too is that because 50% of our members are under 35, most of them will retire post 2050. That's like net zero by 2050. These members are going into 2060, 2070. And this is why, we are gradually, I always say it takes a long time to turn a ship in the deep sea, and investment portfolios are similar, but they are turning, and it is positive, and we're tracking that momentum. And I think we have a lot of investments to look forward to in this space over the next few years. And
just another
Sorry. Yeah, go for
Sorry,
it.
Leilani. And just another dimension of that. So we've talked about it a lot in the Australian context because we're Australian funds and we have that home bias. But increasingly, as the industry grows and funds grow, we need to look internationally in terms of the energy transition. The IRA in the US has brought huge opportunity to the table when it comes to a green evolution of the US economy and related industries across the globe. And so, as a global investor as well, you need to be part of that process because that has impacts domestically as well. So we have been a long-standing investor in Generate Capital, which is a company out of the US who invests in renewable energy platform solutions. And that is just a starting point of what is a multitude of our portfolio that's growing in this space from a renewables perspective overseas as well. So I think it's important to tackle it on all ends and make sure that you're investing at home to help that transition forward. But by sheer size and scale, you have to look globally and see what the opportunity set is and move into that as well. And we've lent into that very much. So as we've globalized, as we've moved into investments in Europe and the US and beyond.
Does the Your Future, Your Super legislation play a part here? And I think there's been a lot of discussion about it potentially disincentivizing investments into some of those more longer-term sustainable projects. Does anybody have a view on whether that's a valid assumption to make?
Certainly, go ahead, Leilani.
No, you go.
Certainly, I think, having a benchmark that gives consistency and relativity across the sector for that 3-year, 5-year, 7-year time frame is really important for members because often they are evolving in those timeframes and their financial frame of mind is evolving. And so it's important to get that relativity right. So there is validity in the Your Future, Your Super tests and catalyzing members to go to higher performing funds so they can get their best returns in retirement, which is core for us. Now, that being said, we as investment practitioners need to take into consideration these long-term issues as well, and climate change being by far and away the biggest one. And I think at times it poses some dynamics, but overall, in terms of the portfolio, it doesn't necessarily change how we think about performance because we're long-term investors by our nature. So all of these issues that we're considering today, we're looking at over those long-term horizons to make sure they're fit for purpose, that assets are performing accordingly and evolving that approach over time as well. So I don't think it necessarily precludes decision-making from a long-term perspective. Perhaps it requires a little bit of a change of dimension, if you will, at the time that you're making the investment decision. But certainly, if you're a long-term investor, those thematics are going to ride out for you, whether you're anchoring yourselves to a relative 5-year performance or whether you're looking at a retiree's typical investment horizon of 30, 40 years as well. So it may pose some issues, but in practice, I think it's better for everybody.
Yeah. I think too that the Your Future, Your Super regulations helps with transparency to members, and members need transparency. And I think when you think about the spectrum of responsible investment, like the ESG integration I was talking about before, if that's just incorporated into every investment and your active ownership that's going to just enhance what you know about your investment portfolio and the decisions you can make. So it's in many ways, it's just part of your investment process that is, aligned with the test. I think where it gets a little bit interesting, and RIA put together a working group that I was lucky enough to be part of in the last 12 months. And it just looked at the choice options. And there was a great piece of work done by RIA where it looked at the time horizon of choice options, what indices and metrics would be comparable to use across choice options. And it also considering that a lot of choice options in the market have been designed because members have asked for their design to be in a certain way. So I think there's some dynamics that are quite interesting just to make sure that we understand in the context of this discussion. The other thing I think that is quite interesting just more generally is that with a lot of investment performance, it's always backward looking. And what we're trying to do is forward looking. So there is a dichotomy that just we need to be aware of when we're making investment decisions, and also looking at how we choose our risk budget across the total portfolio and how we then meet our net zero by 2050 ambition.
Maybe just to, sorry.
Yeah, I mean, I guess the index which it's been compared to, or the indices that are being compared to, are backward looking in terms of that performance test and not deviating too far from that. And sustainability is one of the factors in what's been meant to be reported, but it actually it's not sustainability as we all know of it. It's actually, or think of it, it's more about financial viability. So maybe over time, some more sustainability or environmental factors could be included in that, at least for disclosure.
Similar kind of question from a different avenue this time that's come through in the chat. In terms of that best interest duty that that all the super funds are bound by, how do you take into account, I guess, the tension between what might be the best short-term interests of me as an individual in terms of an incredibly high-performing but high fossil fuel emitting fund or investment or organisation versus the best long-term interest for me is, Leilani, you mentioned many of your your current investors are not going to be retiring until 2060 and beyond. How does that tension get managed in practical terms?
I think we just need to be very honest as far as the transition, and that it's going to be rocky. And there are points in time, things happen in markets that are unexpected, i.e. the Ukraine-Russia war, that changed the dynamic for certain parts of the fossil fuel pathway. Equally, on the opportunity set, we could have huge technology changes just like this that will vastly change the horizon as well. So it isn't one straight, even transition. And I think if you're very honest about that and you're a pragmatic investor, you have to ride that transition appropriately as it presents itself, because we want the lowest economic cost transition for our members. That's the goal here, because we think that will lead to their best retirement outcomes in the end. So we have to be honest that opportunities will arise, both positively and negatively, and we have to ride that wave appropriately. And it's not linear, and sometimes it's uncomfortable, for sure. But sometimes it's also fantastic, and positive opportunities come out of it, and innovation comes out of it as well. And we have to lean into that. So I think here it's just being really focused on the economics at hand as the transition unfolds.
I think active ownership plays a really important part here, because when you're engaging with a company, management will often have a shorter time horizon, where boards will have the longer time horizon. So this is where I think the governance part of ESG really comes to a critical fore, because the boards of the companies that we're investing in, particularly just say in listed markets, should have a long-term horizon. They would like, I'm pretty sure, for that company to be around in 10 and 20 years' time. So I think it's how we engage is critical in this short, long-term time horizon too. But I think funds to manage in members' best financial interests also need to be able to react to market shocks. And to do that, sometimes will mean a decision might pedal backwards for a small period of time. But ultimately, we've still got the goal at the end. And a good example of that is WACC in portfolios, the weighted average carbon intensity. That is not just going to be a smooth curve to 2030 and 2040 and 2050. That's going to have some volatility in it as we go. And that's all part of investors managing portfolios. That's the skill.
And I think going back to Leilani's point around active engagement and management, you need to be singing from the same songbook as your investment teams. So when we directly engage, we're sitting alongside our counterparts in the equity space or infrastructure space. So we're singing out of the same songbook and definitely putting that perspective forward from an investment context that we are long-term investors, whether we're talking to management or we're talking to the boards. So that alignment coalesces and we get that long-term alignment and long-term thinking happening across both parties. And to Leilani's point, the best companies are the ones where management and the boards are aligned for that long-term future. And it turns out best for both the company itself, but also shareholders and our members as a result.
And while you've got the mic, you mentioned before the elbow grease that was required and the fact that this is a resource intensive area of work, and that to do it really effectively does take resource. One of the things we saw in the report was a real marked increase in the number of organisations that were allocating resources specifically to ESG roles. I think there's lots to unpack in that. First question I'd ask is there a tension that gets created by a specific role that's in ESG and might be sitting off to the side, or multiple roles in an ESG team, versus an expectation of ESG as an integrated lens that sits right across the investment team?
Yeah, I think that's a really good question. And practically speaking, I think the ESG role and function as a centralized function is really important, because you have dedicated resources that are looking at all of these variety of issues and how materially they can manifest in the portfolio and how they can apply to different strategies. So we can get a consistent approach that gives us the best outcomes across the different asset classes. So I think that's where the bread and butter is at. Now, you need investment teams that are ESG aware and ESG open, and they understand the manifestation and the materiality of these issues, and also are open to integrating with ESG teams. And as an ESG practitioner, I'm so fortunate that my experience at Australian Super has been that we have been able to work collaboratively and integrate really well across the asset classes with our asset class teams to be able to cultivate strategy to manage these ESG risks and opportunities appropriately for the strategies themselves on a bespoke basis. And when you do all that bottom-up work, it manifests in better enhanced performance on the ESG side, which means that's better financial performance for our members. So that integration is key, and it's not stagnant. It means that you have to be working on it consistently as strategies evolve, as you go global. All of these things come into play, but it's very important that you continue to work at it, and you have that mandate to do so. And at Australian Super, it's very, very clear that ESG is fundamental to how we invest. And that message comes down from the board, investment committee, the CEO, CIO, downwards. So there's no question about the importance of this as part of our investment processes. And the investment teams are right alongside us. And I think we bring, as a centralized function, the future elements. So looking at what these issues will manifest like in the future and how we can build that practically into the investment process to help them manage ESG factors today as well. So I think it's always a tension. It's always going to be a tension of whether you arm the investment teams to do it themselves in some respects, or you keep that centralized function. But for us, I think where you have a really solid integration approach, this sort of working in tandem, one alongside the other, works brilliantly, ultimately for performance and for members.
Yeah, a similar approach at Rest. I really think the central team is frameworks, policies, standards, and enabling what needs to happen, forward-looking. what I see is this evolution in the investment professional generally. And that's what I call the point one or the point two of an investment professional. So the central team's the one, and then the investment professional is the point one or point two. And look at the CFA. They're now offering an ESG module. I am lucky enough to be a guest lecturer on the UTS MBA and Finance Masters course, where there's a sustainable finance module. So we're now seeing a whole new wave of investment professionals come through that are now equipped with responsible investment, sustainable finance tools in their toolbox when they're landing in jobs. So, and that's important because if you're in the property asset class team, you're probably going to want to know quite a lot about GRESB or building standards or World Green Building Council. But if you're in the equities team, that probably isn't as important, and you probably want to know what ESG data is available to you to analyze your portfolio. So part of this skill is actually making sure that investment professionals have the data and skills and capability that's relevant to them in their asset classes to do the work that they need to do when they're talking directly to an investment manager about how that fund or asset is performing. And then there's also the enablement teams. So think about your investment ops teams, your investment risk and governance teams. All of these professionals are now, working on compliance with negative screens and all this new stuff that they are managing. And I just think that as we evolve as an investment industry, it's just going to be part of the investment professional's job with the central team guiding, supporting and having that forward-looking strategic view.
What do you think we need to do in terms of building that capability? And this is sort of the other half to the question. This is evolving at an incredibly rapid rate. There are new skills required all the time. As this develops, how do we build that capability as a sector? Is the sector doing the right things? Does the government need to be involved? How are we making sure that all avenues, and there's a lot of industries where there's a significant sort of stress on talent and attracting really high quality talent. How do we make sure that we can do that over the next couple of years so that we've got the capability as an industry to be able to deliver on some of this stuff? I don't know. Again, that's open to anybody.
I think we need STEM with an A. So, and that means that we need the science and the arts to be covering all of the responsible investment and sustainable finance so across all qualifications, like sustainability and sustainable finance, if it's relevant, should just be integrated into that coursework. I think that would be a brilliant start.
Yeah, I think the education pipeline is super important in the first instance. So making sure that you're getting that pipeline of talent young in there, they're aware of this pathway in this industry and what it looks like in practice. I think also open-mindedness is really important. So there are a lot of these ESG applicable skills that are coming from engineering, that are coming from practical operations in the companies and assets that we're invested in as well. It's about really redefining those skills and saying, look, this is really applicable to the investment space, and bringing those individuals into the tent as well. And that's the way we can nourish growth, I guess, from the bottom up. It's certainly an evolution. We're hungry for professionals in our industry. There's no doubt about it. And we'll continue to hunger for them, no doubt. But if we have a concerted effort to really make that pipeline known and this opportunity set known for other individuals coming into the fore, I think it will be really fruitful for everyone involved. But that means they need to have, to Leilani's point, a little bit of qualitative skills and a little bit of quantitative skills as well to kind of balance it all out. But if you look wide enough and think creatively, I think we can build up our profession really, really well.
Yeah, I can add to that. If you went back, say, 10 years in the, say, ESG, there were very few environmental scientists, very few engineers, very few, I guess, people with a maths background. And it seems like in the past few years that's really increased as, I guess, the metrics and the needs and more the outcomes that are being expected by members and the general public has increased, and I think that it's a real danger to have the finance industry teaching sustainability generally, just because that's not their expertise and not what they I guess are educated about. But you know, if you think of sustainability on one side, and then ESG is kind of the intersection between the finance and the sustainability. So I think having more sustainability environmental scientists and engineers within the ESG community would do wonders for sustainable investing as well.
Terrific. Coming towards the end very rapidly, I guess this report really is a moment in time, a snapshot of where we're at and what we've been doing. Looking forward, pulling out the crystal ball, hopefully we'll be doing this report again in another 2 years. 60 seconds or less, each of you, what do you think we're going to be seeing in 2 years when we sit around the table and talk about what's happened in 2023 and 2024 and what the landscape looks like?
I think the industry will continue to coalesce. I think there will be more and more policy that we're leaning into and clarity from that perspective, and that we will be progressing on those key material issues. And going back to our earlier point, it's not just about climate change, it's all of those in the S and the G basket. Those are really going to kick off and evolve, and funds are going to lean into that as well. So I think we're just going to be, rocket ship forward on the path and the trajectory that we've been paving so far.
Yeah, for me, I think it would be seeing the carbon intensities go down and the gender diversity go up, and that's all levels of diversity. And also, I think a huge focus now on nature-related financial risk and human rights and First Nations has to be up there, and we should see that in 2 years' time in this report.
Yeah, I think that the disclosures around the Scope 3 and the climate, I guess, investment side will be significantly improved from a metrics point of view. And also, I agree with Sandra there around the social, some of the social metrics, and just understanding more about the other sustainability-related risks, whether it's war or food security and other sustainability issues that we have. Also, I think that there'll be a lot more investment in kind of the renewable energy technologies and the lithium and rare earths and things like that. So I think overall we're on a pretty good pathway in terms of transitioning from the climate perspective.
Wonderful, thank you. Zhuzha, did you have a view with your crystal ball out?
Yeah, I think so. I think in the area of what one of my colleagues had said, if it's true that mergers almost grind super funds to a halt in all other aspects, I think once that sort of settles down, I'd like to see greater movement on all aspects of ESG, climate first, nature-related biodiversity issues probably next. But of course, everything and more I'd really love to see more in impact reports, more actual information on the impact that some of your decisions are making, to the economy and and globally as well.
Amen to that. Well, look, thank you so much to each of the panelists for sharing both their insights, but also so much passion and wisdom. It's it is hugely appreciated. And for those of you who have been watching along, thank you so much for joining us. That does bring us to a wrap. Again, just wanted to give a big thank you to PIMCO, as well as Sustainable Platform, for the support that they give us in bringing these reports together. The other big thing, I guess, moving on, there's a lot going on. Obviously, Christmas is coming really rapidly with the AGM, which is going to be in Sydney tomorrow night, an ESG Trends webinar early next year. But the big one for us early next year is the RIA conference It's going to be coming back to Sydney on the 1st and 2nd of May in 2024. We're already putting a lot of the program together for that. A number of you I know are already registered. I would highly encourage you to get involved while early bird registration rates are available. It's going to be an incredible couple of days, and if you haven't come to a RIA conference for a few years, they've certainly come a long way in the last wee while, so I would highly encourage you to get involved and come and join us. But again, thank you so much for taking the time to join us today, and look forward to seeing and speaking with all of you again shortly.